going to go through the first part of the accounting cycle for the third month of business for stock market. So I've got here that in July they paid 1,200 of the purchases it made on account. What's happening there? What is the company getting? Whatever they get, you debit. Whatever they give, you credit. You always put your debits before your credits. What they're getting here is their accounts payable back that they gave earlier when they purchased the merchandise on account. What they're giving is cash. Debit 1,200, accounts payable, and credit cash. Now the way you do the recording is you record it in the journal, and now we're going to post this to the general ledger or ledger. So over here I have T accounts representing the ledger. If you'll notice here, I've got beginning balances, BB. Here's $1,200 of accounts payable. That's because we purchased merchandise. We had last period debited inventory and credited accounts payable, got inventory, and gave an IOU. In this example, we're paying it off, so I'm going to go equal and go get the debit to accounts payable. That's going to reduce my accounts payable, and then the other side is a credit to cash. That's credits on the right. So you can see here that I've now recorded this entry in the journal and posted it in the ledger. The ledger will then have a balance, a proper balance. So at this point I have no accounts payable. I've paid everything off that I owed from last period. Next entry. Purchased 1,500 pairs of socks for $3,000 on account. What are we getting? We're getting inventory. Always put your debits first. And then what did they give in exchange? Not cash. This is on account. Watch that. So accounts payable. And you always indent your credit. So debit, inventory, credit, accounts payable. Then we're going to post copy this information to the ledger. So my inventory had 700 to begin with. Now I'm going to add another 3,000 to it, and I'm going to show I paid 3,000, or excuse me, I owe 3,000 for those goods I bought. Next, we're paying our wages that we owed from June. So what you're getting is your wages payable back that you gave out last period when you recorded your adjusting entries. Excuse me, and the credit is to cash. You're finally paying your bills from last period. So that's 400, and then we're going to post it. Oops, went a little far there. So we have wages payable. We're getting that beginning balance back. That got there when we made an adjusting entry by debiting wages expense, which reduced shareholders' equity, and crediting wages payable back in the period we got the service, and now we're paying our payables just like this. And then our cash went down. Credit cash. Next, selling socks. This is on account, so we're debiting accounts receivable. Receivables are asset. You're going to receive cash. Payables are liabilities because you're going to pay later. So I've got price, $5 times the number of socks sold. And the other side to this, I'm going to skip a line because I'm going to go to my revenue here, because the credit that's going to be that same exact amount is your price times your quantity. I also though have to show that I have cost of goods sold. That's an expense. It's the using of my inventory, and the amount I'm using is the socks have been costing $2 a pair. You have to look back at what you paid for them to know what the cost is per per SOC if it's not given to you in the description. And credit inventory is your corresponding $2,000 credit to balance this debit of $2,000. So again, notice here inventory is going down. Notice cash is going down. Notice cash is going down. I don't use any signs in recording of this. You don't need to. By crediting inventory, crediting assets, that's telling you that your assets are being decreased. All right, so we're going to do the debit to accounts receivable. I've got a debit to cost of goods sold. Got a credit to my revenues. Let me scoot that over a little bit. And then I have my 2,000 credit to inventory. And that records my sale of goods. So we've got now collecting $4,000 from the sales made on account. So this is our customers paying for goods you delivered and recorded as revenue earlier when you actually did the delivery of those goods. You're going to get your accounts receivable back. You're going to have to give up your accounts receivable, excuse me. You've already received it. Going to post it to the ledger. Keep our, so we know what our tallies are at any point in time, because the journal doesn't allow you to see what balances are. So we got cash, and we had to give up the asset accounts receivable. So I just want to make you have you take a look at this. Receivables goes up with sales on account, goes down when you collect them. Likewise, inventory goes up with purchases and goes down when you use them. Now we're going to pay off our note that we have had outstanding for 3 months. What's going to happen here is you're going to credit cash. The amount of cash we pay is we're going to pay all of the note, which is the 1,000. So we're going to pay the 1,000 off, plus we're going to have to pay 3 months worth of interest. Well, PRT 1,000 is the amount of the loan times 6% times we owe 3 months worth of interest, 3/12. So we have to pay 1,015. So I'm going to go over here and actually post this 1,015. And as far as that goes, I'm actually going to put it here. We're giving cash. What are we getting? Well, we're going to get this notes payable back. We don't owe it anymore. Reduce that liability. Debits reduce liabilities. So I'm going to debit notes payable for the 1,000. I'm also going to debit interest payable. And the amount that's in your interest payable is 10. We're going to get that back, so I'm going to reduce it by 10. Now that's not equal to 1,015. I'm off by 5, and notice it's red. That's because I've been using the creditor's money this month as well that I haven't recorded or expensed yet. So in other words, this is let's see, May and June's interest that we recorded in $5 in May and another $5 in June, and now this is the July's $5. So this is what it'll look like when we post it. I already did the cash. Let's do our debits. Debit notes payable, get back your IOU. Debit interest payable, and then I'm going to debit interest expense of $5. Sorry, guess I left that in there, but I'll just do it. Here we go. And that wipes out that note. All right, now we're going to pay our dividends. Dividends have a normal debit balance, and we're paying $200, and we're using cash, giving cash. As far as the posting now, equal, you link everything. It's safe that way because if you make a mistake and you link properly, everything will fix itself. And down here under shareholders equity is my dividends. Again, it's a normal debit balance because it reduces shareholders equity. Once you record your transactions, you prepare an unadjusted trial balance. I'll do that in another video.